everyone, and welcome to this special edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com. Not in Redmond, Washington this week. We're on vacation with the family in Ireland. Hopefully having a great time because I'm recording this just before we leave. But I wanted to leave you guys while I was on vacay, leave you guys with some ideas, some context, some perspective, some tools to help you make better decisions. We've had a lot of fun this week going through the top 10 charts to watch for August 2024. Through the last 4 days, we've gone through mega cap growth names. That was on Monday. We talked about NVIDIA and Meta, what sort of levels and patterns we're looking for. On day 2, we went a little more defensive, talked about consumer staples, some of the impressive rallies we've had in some of those defensive, higher yielding names. Wednesday, we remained in and maybe even got a little more defensive, talked about low volatility, higher income plays in utilities and real estate, and what that rotation to defensive sectors really represents. Yesterday on Thursday's episode, we talked about healthcare. We talked about AbbVie and HCA and really how the diverse sector like healthcare is actually starting to show a lot of signs of life in a number of different groups and what we would need to see to remain optimistic in some of those particular charts. Today, we wrap it up by actually changing things a little bit and looking at more negative trends. 2 charts we're going to talk about are charts that are not particularly bullish at the moment here in mid-August. But what I wanted to highlight for you is 2 things. Number one, why they're not bullish. I find a lot of times, when you think about a bearish chart, like what actually defines that? I think a lot of amateur use of technical analysis is sort of like, well, this looks like a good chart. This looks like a bad chart. What a successful technical analyst, what a professional would do, the pros would actually have clearly defined rules. And even though their comments may imply it's sort of very easy and straightforward analysis, a lot of times there's a lot of rigor and a lot of detail in an internalized set of rules that they're actually following. They're just describing it in a way that probably you're able to relate to. So what actually defines a bullish phase? Well, we've talked about that with a lot of the charts that we've covered so far this week. So today, let's pivot and talk about charts that are a little more bearish. And we'll start with ELF, which is a beauty products in the group called Personal Products on the Stockcharts platform. What I wanted to highlight with the chart of ELF and why I think it's important to watch here in August is because it represents the types of charts that are in a rotation or arguably have rotated. When I look at the chart of ELF, I see a transition from an accumulation phase, in the left half of the chart, to more of a consolidation phase, a sideways phase, particularly, the beginning of 2024, to now a distribution phase. And what gives me the confidence that we're now in a distribution phase? Let's go from top to bottom and talk about each of these metrics and what they represent. So first off, the fact that we attempted to make a new all-time high around 220 and failed to do so. When stocks trade to resistance, but not through resistance, that is an immediate red flag for me, right? Because an uptrend is a pattern of higher highs and higher lows. So if you're no longer making higher highs, the strength of that accumulation phase immediately is brought into question. So I think here in June and July, when we were unable to eclipse the March peak, I think that was an initial warning sign. Then it's what happens when we pull back. And what's happened with the chart of ELF is we've broken below the 50-day moving average. Now we've broken through the 200-day moving average as well. So in an extended uptrend phase, you can see through most of this chart, we spent a lot of time above an upward sloping 50-day moving average, most of the time above an upward sloping 200-day moving average. The last time we broke below was very brief in late October, early November, where we stalled out just below there and then started to rotate higher and push back to the upside. Until you see that sort of rotation indicating that the distribution phase is over, I would be inclined to assume that that distribution phase is going to continue. So I think of this chart as guilty until proven innocent. So we failed to make a new high. We have now broken through moving average support. We're making lower highs and lower lows. All of that is a problem. Another marker here, and I'm going to zoom in to the last 6 months just to show you. We gapped lower in the last week and now have traded lower. When a stock gaps lower, it's always interesting to see if you can recognize buyers coming in, right? A lot of times when a stock has been doing quite well, and all of a sudden you gap down, buyers will be thrilled to get a great stock at a discount, and so they're willing to buy at a pullback level because after that gap lower, they just basically, it's like having a 10% off coupon at Walmart, right? It's just it's a discount from the normal price you would need to pay. That's what a gap lower will mean if it's a constructive long-term story. But if the gap lower is not bought, but as to the contrary, if the gap lower fuels further selling, that represents, I would argue, a lack of conviction from buyers, an overwhelming amount of selling pressure, and the fact that we gapped down and you didn't see buyers really come in on volume, I think is concerning. Below there, we have the RSI, the Relative Strength Index, which is a measure of internal momentum, I guess is what I would call it. The fact that the RSI is sort of consistently below 50 over the last month is concerning. As long as that continues, that tells you the pattern is pretty weak. You can see here in September, October, November of last year, we remained below 50 until we didn't, and that was one of those early signs that maybe things were improving. Here in April and May of this year, we gapped down, we traded lower. The RSI consistently was below 50 until it wasn't on that gap higher, and that was a sign that maybe things are getting better. So until you get that break back above the 50 level, the momentum is overall a little more negative. Finally, the relative strength, the relative performance has broken down, which means that not only is ELF coming down on absolute terms, you're actually underperforming because the relative strength is breaking down as well. So you are underperforming a passive product like the S&P by owning a stock like ELF. So I think this is an important chart to watch, number one, as an example of a rotation, because I think there could be further rotations like this out in the market that we haven't seen yet. I would be looking for this combination of factors to help you identify those stocks that have been doing well that are all of a sudden no longer doing well. A lack of follow through on new highs, all right? You attempt to make a new high and you fail to do so. You fail to hold support. You fail to hold moving averages. We make lower highs and lower lows. We gap lower, then continue. The momentum overall remains weak. The relative strength deteriorates. All of those things are the marks of a bearish chart. That's what I'm seeing here on ELF. Now, that's one that's just starting to break down, which is why I think it's an actionable idea to illustrate about a stock rotating to more of a bearish phase. I also want to highlight something that's been in more of a consistent bearish phase. This is Walgreens Boots Alliance, WBA. Now, this is a stock I love to highlight as just a classic chart in a long-term distribution phase, right? I often get questions about charts like WBA after it's down a lot. And I've had these recently on like Disney and what else? Some of those media names like Warner Brothers Discovery, WBD, or what else would be ones like that? Etsy, Dollar Tree. These are all charts that are just kind of making a consistent downtrend pattern of lower highs and lower lows. My answer will always be the same. I think it pays to be patient and it pays to wait for signs of accumulation. So the reason why I think a chart like WBA is important to watch, number one, this is the kind of chart I would print out and hang it in your office or hang it up from your monitor or something, an example of charts to avoid, right? You want to wait on a chart like this, or at least I do, until you see signs of accumulation, until you see signs that the selling is exhausted and that buyers are starting to come in. We've seen little hints of that, like in December of last year. In other periods, like when we briefly broke above the 200-day in late 2022. But since then, look at how many times the stock has rallied to a descending 200-day moving average and then failed. More recently, we haven't even gotten above a descending 50-day moving average. So I am super happy, being super patient, literally sitting on my hands and waiting for a stock like this to break above its 50-day moving average. When that happens, and only then, would I say, all right, this is maybe a time to reconsider, because at least there's enough of a bounce higher that I'm seeing some buyers come in. We've talked earlier in the episodes this week about the momentum characteristics. Look at how for most of 2024, the RSI has been consistently below 60 and almost always below 50. This is a chart in a bearish momentum phase where the selling is aggressive, the buying is limited, and so every time the stock pops a little bit, you see further deterioration. So this is a chart that I think represents a clear downtrend. The relative performance in the bottom has been absolutely brutal. I challenge you to find a worse relative performer over the last 18 months than WBA. If you can find one, put a comment below. Let me know which ticker. I'd love to take a look at it. The other reason why I want to highlight this is I think especially now when the markets are uncertain, when there's a lot of choppiness, a lot of uncertainty, we immediately look for yield, right? You look for higher income bets. As a matter of fact, on Tuesday and Wednesday, we talked about consumer staples. We talked about utilities and real estate. These are, generally speaking, defensive areas of the market, lower volatility, but they also pay a decent dividend component. So they have a good income component as well. And in a bearish market phase, a lot of times sometimes those can help us outperform. But I would not be too tempted by a dividend yield of above 9%. The reason why that dividend yield is so high is because the price has come down so much. What the dividend yield is basically projecting the forward dividends divided by the stock price. So if the denominator gets smaller and smaller and smaller, the dividend yield gets bigger and bigger and bigger. This is not because Walgreens Boost Alliance is paying a bigger dividend. It's not. And it's not because it's a great defensive play in this particular environment. I would argue it's not. This is a stock that's gone down so much that the dividend yield is so attractive. High dividend payers are good as long as you're not absolutely losing your shirt by the capital losses, right? So if the losses in the performance of the stock completely overwhelm your dividend component, it's not a great bet anymore, right? You might as well just throw your money away and go to a beach somewhere. So I would say WBA, if you scan for stocks with high dividend yields, don't just blindly think that anything on that scan is a good bet. You want to do your due diligence from a technical perspective and make sure that the trends are at least stable, right? Stocks that are flat but paying a good dividend can still be a decent way to outperform in a down market. But charts going down like they are in the case of WBA, for me, it's all about finding signs of stability, finding signs of accumulation that would justify a decent income component, but at least there's stable price action. I don't think I see stability just yet on the chart of WBA. So those are two charts, ELF and WBA in a primary downtrend. Some of the things I would be looking for to anticipate those moves, and then recognizing when those changes occur. And by the way, I would encourage you to think of your charts in a checklist format. That's what I reminded you today. If you think about what we did with WBA and ELF, we started at the top and we went check by check through all of the indicators that I had on my chart. That's the way that I would think of things. And if you're just getting started, write them down with a pencil and paper, literally handwrite what you see with each of those indicators. The more that you do that, the more that you'll recognize what evidence you need to see to justify buy and sell decisions. And you have a great way to learn from your mistakes. So if you go through your checklist, you buy something, it doesn't work, go back later and see what you might have missed, see how conditions may have changed, and help yourself make better decisions the next time. I hope you enjoyed this special series called the Top 10 Charts to Watch for August 2024. We went through a bunch of different sectors, a bunch of different themes, and a number of tools on the Stockcharts platform. I hope that you find this helped you navigate these markets. We'll be back with our show the beginning of next week. But until then, be well, stay safe, have a great weekend, and we'll see you again soon. Bye now.